The little Pringle. Hello. Got a few people coming in.
Hey, Daniel.
Hey, Doug.
Hey, Daniel, how are you?
Sorry, I'm in the car.
What's that?
I'm in the car. I'm muting out.
Okay.
How are you?
I am doing well. I have a surprisingly busy Friday.
That's good.
for an unemployed guy.
Oh, it'll get worse. You're gonna be like, how did I ever get everything done before?
Yeah. This is just like Intel. Meeting.
Yes.
I see we've got our speaker here. Excellent.
Hey, Daniel.
Hello. We're going to get started in just a few minutes. It's always great to see the speakers arrive, though. See, we've got a little over 250 registrations. So hopefully, although we've been trending around having 60 or so people in the group on a given day. So we'll see where we land today. Let's see. Okay. Here they come. Hey, I'm looking forward to talking to you, Jimmy, because I want to hear all about the Texas area right now.
Yeah, we're actually man, the weather's been kind of crazy. It hailed some last week and then it got sunny, and then I'm expecting here in about an hour for another severe storm, hail. So
Hello, Ashish. We got to bring in some more speakers that you suggest. Actually, I do need suggestions for speakers. We have open slots coming up.
Yeah, I just sent you an email.
Yeah, oh, perfect.
I sent you an email on this company called Vint. They do wine and spirits.
Okay.
They basically securitize wine, extremely high-end collections of wine and spirits, and then they package them up into a portfolio.
Okay. Syndicate
So he's
your wine.
available.
I do like the syndicating of breeding of exotic animals. Syndicating.
Oh, yeah,
okay. I want to hear about that investment.
Okay. Did you reach out to them?
Yeah, you know what? I meant to, and something else I had to do, and it's on my to-do list still today. So,
okay. I
got
think they're having it in Texas, or they're based in Texas, and they're having some sort of big shindig this weekend, so probably gonna be busy.
Oh, okay. Breeding wildebeests in Texas. Hello, everybody. Speaking of wildebeests, here's Jimmy.
Hey there.
We're going to get started in just a few minutes. Sorry, I didn't mean to call it out like that. Still waiting for people to come in. Hello, welcome. Hey, I would love it, and I don't know if this is going to happen or not, but at some point, maybe today, maybe next week when we're all warned, I would love for everyone to turn their video on and to take a group photo that I can put on the webpage. So you know what? Let's do a quick poll. How many people would like to do that this week? Put a 1 in the chat. And if you would like to do it next week, put a 2. Two, 1 and 2. It's true. You can never have enough shots to choose from. Sounds like we're doing it next week. Most people are saying 2. Of course, if I ask the same question next week, it's going to be 2 again. All right. All right. So, Jimmy, it's great to have you here. Just to give a little bit of introduction here, and let's make sure we have the recording going. Yes, we do. So just to give a quick introduction to the topic here, one of the reasons why I'm really interested in Texas is because in the current economic climate that we find ourselves in, prices are extremely high. Almost everywhere you look all around the country, cap rates are going down, commercial properties are going up in price, and it's getting harder and harder to find good deals. And so one of my themes for this year is, or two of the themes actually, are that if you can find a good deal that provides tax savings or ways to minimize your taxes, that's a great way to go, because I see taxes as becoming a bigger and bigger portion of most people's expenses. And then the other way is to opportunistically find deals as the environment becomes more difficult. You're going to have operators who just aren't performing and need to sell their properties. And I have a cat going across my screen. So there are people that are going to be going into distress out there. And my understanding, or at least my take on some of the recent uptick in the Texas area, is that might be some of what's going on in Texas. There's definitely been an uptick of transactions going on in the real estate market in Texas. And I would really love to dig into, your thoughts, being boots on the ground in that area, and just what your take on it is. But this is Jimmy Edwards. His topic is scaling from 5 to 25. Welcome, Jimmy, to the Alternative Investing Club.
Yeah. Thanks for having me. I appreciate the warm introduction and opportunity to share some information. So yeah, I mean, whatever, however you want to lead.
All right. You know what? I want to lead by getting rid of the cat. All right. So let's just have a dialogue then, and we'll keep it really informal. And if you on the call want to chime in, we only have 35 people in the room today, which so you know what? I will actually stay here. I would love for everybody here to go and invite another person that you know. We apparently have had quite a bit of attrition coming outside of Intel. And if you know somebody who you think would benefit from this club, just invite them to the club. Feel free to pass on the calendar invite or the email that I sent out. I hope you're all getting those. I'm actually not sure. I'm using a different service. But feel free to invite somebody else. I have another podcast that I really like that says, pay the fee, invite a friend. All right. So Jimmy, tell us a little bit about yourself.
Yeah. So I'm in Texas. I'm in Dallas. I'm a Texan my whole life. I've lived in pretty much every area of Texas: Austin, Houston, Lubbock, and Dallas. And I've been pretty much real estate investing my whole career, or some form of real estate. I started in condo sales in 2006 and 2007, and then moved into mortgages during the last recession. Did well there, and then 2013 started buying single family homes and flipping homes full time. We did 100 flips or so, and accumulated some rental properties. And there were several turning points in that business on thoughts about scaling, and we got introduced into multifamily and kind of realized that's a more scalable model. And so to 2017, bought a 16 unit deal, and then since then bought several 100 unit deals. We sold a lot in 2021 and 2022. So we kind of timed the market pretty well. Last year was stressful trying to sell some deals as interest rates were rising, but we got it done, and had some phenomenal returns. I mean, one deal was like a 5x return. So found some good markets. I think the kind of the mindset of flipping houses helped going into multifamily. We started looking for really just distressed physical deals, and along the way kind of realized it doesn't have to be that hard. There's a lot of value add opportunities just in operations, right? So you can increase income and decrease expenses to create value. So I really like the apartment model, because you can force appreciation versus single family homes where you can rent a $100,000 house for 10 grand a month, but that doesn't make it worth any more than what the neighbor's house is worth. So I like apartments.
Oh yeah, so let's dig in a little bit there. So most of the people here are probably passive, on the passive side. but you mentioned fix and flips, and that's something that we haven't talked about too much. I want to understand, what did you like about the fix and flip business, and why I hear that people go to multifamily fairly often. What are kind of the nuts and bolts reasons why? What brought you out of that?
Well, it got harder to find deals. It was a lot more competitive, but if you could find a deal, you most likely would make money. But, the challenges were scaling that, right? So, we didn't really focus on any specific zip code. I mean, I would buy, DFW is pretty large, right? I mean, there's 5 or 6 million people here probably. And, it's a large metroplex. So we would buy, anywhere within an hour of home base. And we did really well. But, when you're scaling that business, you have to find more crews. And with more crews comes more headaches. And then, we had one instance where we put a house on the market and in that same subdivision, the same weekend, like 6 other rehabs came on the market. And so it diminished the value of our property, right? And
were you ever able to scale the capital going in? Did you take investor money in order to do the flips, or were you doing this all from your own proceeds?
So I started with my own money. And then I ran into the problem of, finding too many deals, right? I'm a really good hunter. I'm good at finding deals, and kind of built the team around that. My current partner, her background is in construction management. And so we kind of created a conveyor belt. But we did, I didn't know anything about syndication at the time, but, we were finding deals, and I had friends asking me, if they could invest. And, I started taking, basically, hey, if you can fund the down payment, we'll split the profits. And that got, I had a lot of people involved in that, and that became, challenging. Everyone had a different priority. And so eventually I took on one investor, in order to scale the capital side of that. We kind of structured that as, like a second note. It was a promissory note, and, it was more of a interest type, loan as opposed to like a profit sharing. So it was mutually beneficial. That worked out really well. But I mean, the biggest challenges were just, having deals spread apart, different areas, and then, being subject to comps in the market. And what I really found more beneficial in multifamily versus single family is, you can buy an apartment that's maybe not performing to your expectations, but it's still covering the expenses, right? And so when you're flipping houses, if the longer it takes, the more cost you incur, you don't have anybody covering the nut, right? So you can get into a situation where your profit's extremely diminished just because there's no one there. So really getting into, value add, apartment buildings is it's much different in that aspect. I mean, unless you really dip on occupancy, but a lot of times we know if that's going to be the plan, right? So for the most part, you're covering your expenses. You can, get through any time of the market if there's market changes, as long as you have the right kind of debt. So,
okay.
I
think I want to hit on 2 topics,
Sure.
the scaling from 5 to 25 units. And then I really want to hear your take on why in a difficult market, the DFW area seems to be picking up in transaction volumes, and what's your take on why that's happening? So take those in either order. And we'll just talk our way through.
Yeah.
And,
I mean,
and everybody here, feel free, put questions in the chat, or, if there's a moment, feel free to take yourself off mute. There's only 43 of us in here at the moment. So I think it's small enough. We could have people chime in with audio.
Yeah, totally. I think for the most part, Texas has been a pretty resilient market, over, the past couple decades. I mean, even in the last recession, we had a dip, but it didn't dip, as much as other markets. So, I think a lot of that has to do with the jobs, and also, we've been kind of undervalued. There's a lot of land, there's a lot of room to grow. And typically it's been, pretty affordable, right? So as prices climb, because we're not restricted to, certain land area, it remained affordable.
Okay.
Now,
I guess I had always thought, maybe back in 2018, 2019, 2020, that Texas was sort of hitting its peak, that things were getting really expensive there. And for a time, it looked like it was really cooling down, that transactions were going down in volume.
Yeah.
And then here in this last year, it's just started to pick up again. And
it's been, yeah, absolutely. I mean, prices were getting high, but I still felt like they were good prices. And I think, there's several components to that. And one is, there's been a lot of driving factors as far as employment, right? But we were still undersupplied. And I think that the reason, to the end point that you're saying, is just supply and demand. So, it's if you're talking about the East Coast or the West Coast, it's still affordable, right? I mean, $185,000 a door to me feels expensive, but from other parts of the country, that's a good value, right? And then, our, public policy, I guess you want to call it, we're a little bit more of a red state, so it's easier to evict people. And we've still been undervalued, but there's still a lot of product. And then the amount of jobs coming here continues to create, supply and demand. So,
okay, so it's really about demographics then, I guess, is what you're saying, is that just people are coming there, and that's what's maybe driven some of the recent boom. And it's not, correct me if I'm wrong, is some of it from deals that are no longer or properties that are no longer performing, or they're being mismanaged, or because rising interest rates have crimped a lot of people's cash flows? Are there deals that are just not working out well, and then that's causing the transaction volume to go up? Or is it mainly just demographics?
I think it's a lot of demographics. I think there's, a lot of people that are executing their business plans. They started in 18 or 19, and then, we had an extreme surge in 21. And, I think there's a lot of people that are exiting now because they're hitting their business plans. And a lot of those are likely trading on assumptions. I think that I've heard about deals with bridge debt where the interest payments are unmanageable, but I haven't seen a ton of those. Some of those are trading off market. And I think in a lot of those instances, the investors are still trying to hold on, right? And so I think
really quickly for the group here, could you define what bridge debt is?
Yeah. So it's agency debt is typically, they have some variable rate, but it's, a longer term fixed rate debt, right? So you have agency or even bank debt. Bridge debt is typically a shorter term loan. It's usually 3 years, and you have an opportunity to extend maybe 1 or 2 years. But a lot of bridge loans had variable rates, so it wasn't a fixed rate vehicle. So what's been happening is, they had a 3-year loan, and when they got it, rates were 3%. Rates have gone up to 7, 8, 9, 10, 11 in some cases. And so, you could buy what's called a rate cap, but depending on when you got the loan, that was expensive or inexpensive, or, maybe you only got it for 2 years, right? So now a lot of people are in a position where their loan is maturing, which means it's due, or they can get an extension, but the rate cap is expired. The interest rate has gone up. The cash flow is not covering the interest, and typically you would refi or sell, right? But because interest rates have gone up, cap rates have also increased, right? So, now property values have come down, which is, only a short-term deal, right? I mean, if you're in a fixed rate loan and your business plan's 5 to 7 years and values come down for a little bit, that's okay, right? Because you're going to ride it out. You got tenants paying for the debt. But these bridge loans, they're risky vehicles. I mean, they're great in a market that's escalating, right? You can get in, you can get out.
And people mainly got them so that they could agency debt from Fannie Mae or Freddie Mac, they wouldn't lend to you unless you had at least a 90% occupancy. And so a lot of these properties might have had less than that. And so you get bridge debt, you'd go in there and renovate the units and,
Correct.
you know, bring it up, bring your occupancy up, and then you go refinance into agency debt. And so that caught a lot of people off guard because interest rates went up.
Yep.
And long-term fixed debt, I think, is what smart people did.
Yeah.
You have a
Maybe
question, Glenn?
Yeah, maybe to piggyback on what you're asking, Daniel, and the way you'd answer Jimmy, you know, from the Texas market is do I derive from this the conclusion that says that yes, there is a likely coming rise of mismanaged property that has not yet hit the Texas market when you were talking about kind of the up down and value prop and so forth, because we're just at the beginning of maybe that wave of those bridge debts that are really coming to that pivot point.
That's my belief. Yeah. I mean,
Got it.
I'm, you know, I'm a buyer. If I can get a deal to pencil right now, I'm buying because, you know, I think that, you know, even if the market goes down a little bit more, right? If values go down a little bit more just because of interest rates and cap rates, I still think that on a 5-year business plan, in 5 years, values will be more, right? So, you know, but I do believe that we haven't really seen a lot of fire sales. And I don't know that we will, because there's still a lot of capital, again, coming from other places where they believe in this market and know, you know, kind of the same belief that I have that, you know, anything you buy today is going to be worth more in 5 years, right? So there's, you know, and it's similar with single family, right? Like a lot of people have equity. And I even though there's a lot of deals right now where, I mean, I've seen some deals that, you know, it traded for less than what the loan is, right? So it's, you know, maybe they had an 80-20 loan, you know, and people are buying just paying for the note. But there's still a mass amount of capital coming in. So there's still people chasing deals to where it's not, I haven't seen the fire sales, but that's not to say that we won't see them in 6, 8, 12 months. I mean, it's entirely possible, but I still feel like there's a lot of capital chasing deals that it may still be competitive enough to where, you know, they're not a total fire sale. I don't know.
If your demographics are continuing to rise, it's going to dampen the fire sales that are going on, because people are going to be able to, you know, even if their mortgage payments go up, they're still going to be potentially collecting more rent, and that'll stave it off. Okay, well, I guess let's pause for questions here, and if there are no questions, we'll go on to scaling from 5 to 25 units. Any questions from the group?
Hey, Jimmy, Brad Susmith here. I live in Austin. I was wondering, what markets in Texas do you think are good ones to invest in and which ones are bad to invest in?
Sure. So, you know, we've owned in Dallas, we've owned in San Antonio, we did real well in Lubbock. We bought good deals there. Let me say that. We got them at a really good basis. I am extremely confident currently in the I-35 corridor from Dallas down to San Antonio. That's my kind of target area. I think Waco's great. I think I think really Austin, you know, if you would, you know, number those in, you know, hotness, I would say Austin, Dallas, and then San Antonio kind of comes behind Dallas, and then Waco is behind that, right? Because it's kind of in the middle. So, you know, I always say, hey, if things are trading, you know, for 250 in Austin, the same type of product is, you know, 200 in Dallas, you know, 150 in San Antonio, and 125 in Waco, right? So you can kind of follow the trends based on the demographics there. I know people have done really well in Houston. I just, you know, I don't know that market that well, and being in Dallas, and, you know, I'm from Austin too, and we own in San Antonio. I've just kind of focused on that I-35 corridor. I don't know much about Killeen. I haven't invested there. You know, I think San Marcos is strong. So, you know, San Antonio is a little bit weaker, than, you know, say Austin or Dallas, but I still think it's a good market. There's opportunity there. So really those the main I-35 corridor. I've kind of, you know, we used to buy in the tertiary markets. We could get, you know, good deals there and we could drive value, but you know, I've just found that it's more difficult to push rents because the population isn't growing as fast, right? So, you know, you're kind of fighting yourself on some of those deals, unless again you just buy, you know, a really good basis fire sale type deal, which is what we did in Lubbock.
Okay.
What do you think the best? Oh, I'm sorry. Go ahead, Brad.
Well, I was just going to ask a follow-up question. What I've always heard is that Austin is too expensive to find a property that cash flows in a reasonable time frame. Is that your experience, or are you finding cash flow?
I have never found a
opportunities
deal
here?
in Austin that makes sense for me.
Okay.
That would be correct. So my belief is that Austin is similar to the thought process in say New York or Los Angeles, where it's more of an appreciation play, right? So
Right.
you know, a lot of those people are just, you know, I mean, they're chasing a 3% yield that you know may or may not cash flow, but it's more of a capital preservation play based on appreciation.
But do you do those types
I
of
don't.
deals, or you?
I
avoid
know
them?
that the only time well, my very first mentor taught me the exact opposite. You don't bet on appreciation. And so, you know, I've really, you know, and I was doing mortgages from 2008 to 2012. And that's when I saw a lot of people really get hurt. Right. So, I mean, the fundamentals are, you know, based on cash flow and appreciation is a bonus. Right. So no, I don't.
Okay. Thank you. Sorry,
Yeah.
Daniel, go ahead.
Just, can I add one in before we move on? Just a question on how you find your crews. One of the things that's been a challenge for me is I've considered doing either houses, haven't considered doing multifamily, though I own some multifamily, just by not getting rid of it. Is the challenge with finding a crew if you're not there on the ground. So if you could speak to that, how you assemble them, where you find the folks, is that all through connections, or is it through just raw recruitment, going out to Thumbtack, or how you put those together would be helpful.
Man, yeah, I'd say a lot of it just comes down to grit and being resourceful. I mean, in Dallas, you know, we've been here for a long time, and referrals after referrals after referrals, and we've built, you know, really good network. Lubbock was challenging. You know, we started fresh there, but you know, we kind of leaned on management company, and we leaned on, you know, some property managers and things like that. Kind of the same in San Antonio. You know, we've got our second property there now. We bought and sold one. And that property, the first property we bought, we really leaned on the management company since it was a multifamily deal, and they introduced us to a lot of folks, and you know, we've used them at our second deal there. But I mean, I'm not gonna lie, it's been challenging. Labor has been extremely challenging, and that's really one of the hardest parts of the business is, you know, even property managers, maintenance guys, plumbers, electricians. I mean, all of the trades it's sometimes I wonder, you know, why it's so hard. But you know, I mean, that's, you know, those are all things that you fight through, and that, you know, at the end of the day, if you know, you can fight through those, you make money, right? So it's like, you know, in different market cycles, you have different challenges, and labor's been one of them. But you know, I mean, we really like referrals, just asking people, just like, you know, you just did. I mean, that's what we found to be the best. Some of them work out, some don't, but.
Got it. Makes sense. Thanks for that.
Yeah.
All right, let's move on to, I know there are quite a few people in here that have rental properties, and your topic was going from 5 to 25 units. So what can you tell us about that?
Yeah. So, and you know, my thought process behind that was going from, you know, 5 buildings to 25 buildings, but I mean, it can be the same from, you know, houses, right? I mean, you know, 1 house to 5 house. Like, my belief has been, you know, that you can successfully manage 1 to 5 deals, right? You can get one deal, you can fight your way through it. You know, you can kind of, you know, you can get to 2 to 3 to 4, but at some point, just like anything else, it becomes unmanageable without systems, processes, and people, right? And so that was kind of, you know, what I learned in single family with, again, going back to the investors and the capital, getting pulled in many different directions. And then, you know, same thing when we scaled the single family business, getting pulled in many different directions. And then we, you know, condensed to apartment buildings, but then we had multiple apartment buildings in different places, right? And so really what we've been working on, kind of while the transaction activity has been a little bit slower, we've offloaded a bunch of deals, you know, we've got capital, we're waiting for more deals, and really, you know, scaling back, untangling and rebuilding, right? I mean, you know, you guys know about systems, but I mean, automations and processes and procedures that create a conveyor belt, right? So, you know, really finding the right people and building a team just to go bigger, right? When everyone's in the right seats, things tend to move, you know, much more fluid. So, I mean, that's really, you know, kind of the basis of what we've been working on. And again, you know, going back to the last question is, you know, when you have your trades, right? When you have your lender, when you have your title company, when you have your insurance guy, when you have your trades, you know, you have your go-to people. And that's what I found allows us to scale every time, is having, you know, using the same people for the same process over and over again, allows you to scale.
So, I mean, the key people there, people that you know and that you've worked with before, that includes your property managers, your contractors. Who else would you put as key personnel that you need to build out when you're scaling like that?
I mean, pretty much every vendor in the part of the process. So yeah, I mean, your property managers, I think having, you know, I mean, insurance has been crazy down here. So, you know, having the right insurance person, so like you're not pulling your hair out at renewal time. You know, they're thinking ahead, right? They know what's coming instead of just getting an invoice that's, you know, 100% more than the last one, right? And then backtracking. So, you know, having trusted partners, you know, I look at everybody, you know, every vendor in the deal as a partner, right? I mean, you want to have a team just like, you know, an NBA team or an NFL team, right? You need everyone to be on the same page and to have the same vision. And so, you know, same thing with lenders, right? Like, you know, we had some bank loans with variable rate, but they had built-in caps, but they were still 7 years long, right? And so like having the right lender that understands your business plan, but also still, you know, understands the risks, right? So like having trusted, you know, advisors and partners.
Which lenders do you like down there? Or do you work with community groups or banks or?
Yeah, so, well, and I say that I like smaller community banks that are relationship driven, but that can only go so far, right? And then, you know, as you get into bigger deals, you know, I like agency debt because it's fixed and it's long term, right? I mean, that's the thought process has always been like, man, this is great if we can execute our business plan in 2.5 years, but like, what if we can't? I need some more runway because we got a lot of money invested in this deal. I would rather wait and not lose money than be forced to sell and lose money. So really like local community banks where they're interested in the relationship. And, you know, and that's kind of the thing with a lot of these bridge lenders is they're kind of interested in taking the deal back. They kind of want the deal if it doesn't work out, right? Whereas like some of these banks, they want us to succeed. So, you know, if things do change, you know, like we closed the deal in December, and at the closing table, the lender kept saying, hey, you know, keep in mind, I can change these, I can modify these loan documents at any time, right? Like he put an emphasis on, you know, if the market changes and something happens, like, let's talk about it because I want you to succeed. And so like, to me, that's very important, right? So, just, looking at everybody as a partner, right? Like I'm a real estate guy and that's what I'm good at. But like, I have a background in finance, but like, again, the insurance guy knows the market, the lender knows all the loans, right? So just.
So, okay. From the point of view of the passive investor, which is what most of the people are here,
Yeah.
Is it a good time to be investing in the Texas area? And, maybe if you follow other markets, are there better markets out there? What's your opinion of Texas versus other parts of the US?
So the only other part of the US that I really looked at was Arizona. But I don't know how it's doing right now. We didn't end up closing that deal. I know that people have done really well in Arizona. But at the end of the day, like there's so much here in Texas that I just really,
There's plenty to do there.
there's plenty to do, right?
Right.
So, I think there's a lot of other good markets, but I don't know enough about them.
What would be the main like business plans that investors should look for if you want to get a home run deal or a double, a solid deal?
Yeah.
What parts of the business plans should passive investors be looking for if they're evaluating a Texas deal? What do the general partners need to be doing?
I think the location, the number one rule in real estate is location, right? I mean, I see a lot of people, like everyone likes B deals, right? Because there's still opportunity for value add. But I mean, there's B deals in D areas, right? So like, you really have to look at, hey, this is a nice looking property, but like, where's it located? Like, what are the demographics? And so for me, what I really like is buying a deal from a mom and pop owner that's owned it for 20 years. Their loan's paid off. They've been cash flowing. They like it to be full, but there's a lot of opportunity there, right? So like, sometimes it's physical, but sometimes it's just operational, but you have to be careful. Can you push rents that high? Like, where are they?
Hey, really quickly, could you define what a B deal is?
Typically, 1980 to 2000. But, and I would say like C deal is probably, early 60s to late 70s, right? In 1980, they got away from,
Building codes improved.
Yes, building codes improved. Sorry, I had a brain fart. I was thinking about the plumbing lines, right? So you got away from cast iron, you have PVC. You got away from chiller systems, you have individual HVACs. You got away from flat roofs, you have pitched roofs.
Don't buy a chiller. Don't buy a chiller.
Yeah,
I mean, you can make it work, but so a chiller, for those who don't know, is one unit that cools the entire building, all the units, and if it breaks down, it is a huge expense.
It's not fun. It's not fun. You have a lot of angry residents. And those properties are typically all bills paid too, right? Because you have the chiller, the property pays the electric bill, and it's included in the rent. And so the demographics of an all bills paid property is different than someone that pays their own electric bill, right? Because it's individually metered. So, but to that point, like we bought a deal that was built in the 60s, but it's in an A location. So I kind of value that as a B type deal, right? It's an older building that we rehabbed and, it's kind of right in the middle. So it's a little bit, lower price point than all of the brand new construction around it. So I think it's,
So from like a passive investor's point of view, actually, why don't you, unless we could pause for questions here too.
Yeah.
Let's do that really quickly. And then be thinking of a deal that you want to walk us through the numbers for that you've done either recently or one that worked out well. Recent would be great.
Okay. Daniel, I have a question.
Yeah.
He had mentioned insurance, and do you have multiple? Do you run with like 2 or 3 insurance agency, or you focus on one only?
So I've done both. And what I've found, commercial insurance is very strange. One broker can actually tie up different agencies as the broker of record. So if you try to shop commercial insurance, it can get blocked, which is an odd deal, but that's for another day. I've tried using a couple different guys, and what I found is that, you know, just with anything, you know, at the end of the day, you've got salesmen, and then you've got people that really know what they're doing, right? And I've found I have one guy that I really like, and he knows, he's been doing it for 30 years, and he knows all the carriers. He knows what's coming down the pipeline. You know, maybe there's someone out there that could get, you know, 1% or 2% lower, but at the end of the day, like, I find value in knowing my trusted advisor, you know, has my back, I guess, really. But
Hey, just a question on that. And are you using that guy across all of Texas, or
Correct.
do you have different Okay, gotcha. Thanks.
correct.
How
Yeah.
much have insurance rates gone up recently? I know Florida, they've tripled, but Texas, what are they like now?
So we had our policy, we had $130,000 policy, and it renewed at 205,000. And it was and again, this is part of the reason why I'm looking I'd probably say 1985 or newer, because there's a lot of carriers in the older stuff that dropped out. So now there's like one carrier that's basically got a monopoly. And on that particular deal, we were guilty until proven innocent. We had to go get an electrical inspector, we had to get a plumbing inspector, and we had to do something else to prove that we did not have aluminum wiring, and we did not have this, that, and the other. And then they rebated us $30,000. So we got down to like 175, but I mean, it still went up $40,000 in 12 months.
All right,
Hey,
go ahead.
hey, sorry. Hey, Jimmy, just want to circle back on your comment earlier about community banks versus, you know, bridge lenders and so forth. Do you, do you find that you're trading a bit of interest rate in that approach, but you're trading it for the flexibility of the duration, as well as in theory, you know, preferred relationship with, you know, subsequent deals and so forth? Is that your thesis?
Yeah, I believe so. On most of those bank deals, there's no prepayment penalty, but the length of the loan, the fixing of the rate, and the relationship is important. I mean, I would say, and I actually think that the bank loans lie somewhere in between bridge and agency. So, you know, agency is always going to be the cheapest. I think bank is a little bit higher than that, but bridge is, you know, typically more expensive. From what I've seen, let me take that back. There was a point in time where bank was the most expensive. But as far as interest rate, but we still opted for that to exactly your point. Like, it just, there's a sense of, you know, reassurance that, you know, we had more runway. Yeah. And flexibility. There's no prepayment penalty. So.
Do you, just a quick follow-up, do you typically still do some sort of interest only period before it started amortizing with that model, or are you doing it right away?
Yeah, we got the last deal we did, I would say in general, the last 3 deals we did with bank loans, we probably got 12 to 24 months of interest only. The last one, I think we got 18 months.
Okay, thanks.
Any other questions from the group? What do you guys want to know about investing in Texas? All right.
I'd like to know about property taxes. It's a big difference in Texas than in other states, just in how the revenue mix is done. So how is a commercial, commercial person, how are you dealing with that in the mix?
Kind of goes back to the same thing I was talking about earlier. We have a tax, you know, protest company, I guess, and they go through the protest process, and, you know, sometimes we end up in litigation, and I've been using the same guy for 5 years. And every time I buy a deal, I ask him his opinion of the next 36 months, what's this going to look like? And, he gives it to me. And, we fight taxes on every deal. I mean, they're always going up. But yeah, it's definitely, I mean, it's way different. Insurance and taxes are a huge expense, which makes the price per door feel lower, right? I mean, just compare, say Arizona, for example. I mean, the same deal, insurance would be $6,000 instead of $100,000. Taxes would be $20,000 instead of $100,000. But, price per door is 300,000, right? So it's all part of it. But I guess to your point, you can anticipate a little bit more, on those lower amounts. We've just gotten comfortable with expectations and underwriting, what we feel is comfortable and what we think is realistic. And, usually we're pretty close, right? But sometimes, we're off, but, we navigate and get through it. But we're always fighting taxes. I mean, that's that's inevitable.
All right. I don't, if you want to lead us through a deal, go ahead, Don.
Okay, thanks, Daniel. Jimmy, one other question for me anyway, on the cash flow requirements, or not cash flow requirements, but capital requirements for single family versus multifamily in Texas. What are you seeing just in general in the ballpark on a ground floor, or maybe entry level deal?
On, for the single family stuff, I'm still getting 20% down, 80% purchase plus rehab. On the multifamily, it's changed. And that's also part of the reason people move towards bridge loans. The lenders, especially with agency debt, they have a DSCR requirement, which is, typically around 1.25. And so what that in the early years, 17, 18, 19, I mean, you could get a 80-20 loan, an 80% loan and 20% equity. And even in some cases, we had one bank loan where I think we got 83, 84%, because it appraised, high. But what started happening is, because the market was still hot, people were getting these short-term bridge loans, which didn't have as much concern for DSCR. So values started to go up, and with the agency loan, you could still get up to 80%, but it was restricted by DSCR. So, the DSCR at 125 might have only allowed you to go up to 73% loan to value. So the down payment increased as the values went up, but the cash flow wasn't able to cover the debt service, right? So like the last deal that we closed in December, I think we put 35% down. But it was a little bit different deal. Like we were, it wasn't going to cash flow for the first, 6 to 8 months because we were going to renovate a lot of units. So the lender was comfortable with, that amount, but they also saw, hey, rents are going to be $500 more than they are now, when we're done. So, again, just, using a little bit more of a sensible approach of seeing the entire business model as opposed to being, stuck on just, certain requirements. But I mean, you can, if you can find a good deal, I mean, I think you could probably still get, agency debt and put 20% down, but those deals are pretty hard to find, so it depends on the deal.
Got it. Thanks for that, Jim.
Yeah.
All right. And as a last question, can you walk us through some of the numbers of one of your previous deals?
Yeah. So the most interesting deal we had, it was a 1031. We actually did a reverse 1031. We found a deal in Lubbock, Texas, and it was mom and pop deal. It was a dentist. He'd owned it for 20 years. I think he inherited it from his father. There was no debt on the property. He was making, $180,000 a year in cash flow. But it was kind of basically self-managed. Like a buddy of his from high school was a property manager and also the maintenance guy. They weren't really using computers. All the rents were kind of in his head. People kind of paid, based on handshake agreements, and they like to keep it full. We bought that deal for, I don't know, maybe it was like between 35 and 39 a door, which was pretty low. I think we paid like 3.9 million for 120 units. But this was in 2019. I think we sold it for 65 a door, maybe. But again, that was a deal that, they didn't really have financials, right? And so I was interested in the deal. He was interested in selling. 35 a door sounded good to him because, they probably bought it for 6,000 a door, right? So, but again, I went to the bank and I said, hey, like, here's my pro forma. They don't really have records. And the relationship paid off, right? And so they said, hey, based on what you're showing us, we're willing to lend this amount. And that's when I went to the seller and I said, hey, like, I want to buy this deal. Here's why I can pay what I can pay. Maybe you could get more out there in the market. You're seeing comps, but like, you don't have the data to support a sales price of that, right? So we closed that deal kind of on, shoebox financials. And, what was interesting is that they were telling us it was 98% occupied, right? And we didn't have a rent roll, and we kind of trusted that. And we went and did our inspection. We were walking units and vacant unit, vacant unit, vacant unit, vacant unit. And I'm like, hey, what's I thought you said you were 98%. She's like, oh yeah, no, we're 98% on ready units. And in my head, I'm thinking, okay, 98% on ready units. And I'm like, well, what's wrong with these? And she's like, oh, we just haven't gotten to them. And they were, in my opinion, they were $150 cleaning fee away from being ready, so 30 units, they probably could have got them all ready for $5,000. But they just weren't used to doing that. They were just, hey, if we get a unit ready, we lease it immediately. And in my head, I'm like, well, let's get these units ready. So we kind of found some meat on the bone there. We closed that deal, got all those units ready in like 30 to 60 days, got them rented, actually got up to, above 90%. And when we bought it, the rents were $200 on the market because they weren't using any systems. They weren't marketing. They weren't online. Like, anytime I go to buy a property, I'll Google it. And if nothing comes up, I'm like, yes, this is a deal I want to buy, because they're not utilizing technology, right? And so that was kind of what we did with that deal. And we bought that, I think, either 2018 or 2019. Actually, it was 2019. We bought it late 2019. And then, of course, 2020, COVID came. We stopped spending money. But we by the skin of our teeth, we got above 90%. So we rode out COVID. 2021, we started spending money a little bit again. We positioned it to get it for sale. And then I think we sold that in late 2021. And I think we got around 8 million for that. So because of the loan on that deal, I think we put down about 750,000 in equity. We got a really good deal on that, on the loan. That was back, again, going back to like, hey, it appraised for, a good price. We'll give you up to 80% of the appraised value, which was 84% of loan to cost, right? So we put down like $700,000, between $700,000 and $800,000. That was, we 1031 from a previous deal. And then we sold it for around 8 million. So we cashed out, about 4 million in equity. So, it ended up being, I think it was like 4.82x, close to a 5x, return. I think it was like a 70%, annual average return, but it was
That's awesome.
crazy.
That's a great deal. You mentioned reverse 1031.
Yeah.
How was this reverse 1031? I don't think I quite follow
Sure.
that concept.
So we bought I'll back up and I'll kind of tell it. So we bought a 16 unit deal and we got 100% purchase financing on that deal. So we paid $800,000 for that deal. They gave us an $800,000 loan. And then we funded the rehab. And so the rehab was about $300,000. I think we were in it, maybe it was a $900,000 loan. We were in it for like 1.2, sold it for 1.6. Does that make sense? Yeah. So 700,000. But what happened is we had this 16 unit deal for sale and we found this 120 unit deal. And my intention was to line up those dates to do a regular 1031 exchange. The buyer on the smaller deal got delayed and the seller on the bigger deal started getting anxious. So what we did was we pulled our money together, the 700,000 for the down payment, and we funded the new deal. And then when the 16 unit deal sold, we basically got reimbursed for the $700,000. So there was a lot of paperwork in the background that it qualified as a 1031 exchange, but we funded it and then got reimbursed, but it still qualified for tax deferred 1031.
How did you find a lawyer to handle that?
So there's I think they're out of Colorado. 1030, I think the name of their company is 1031 Exchange Group or something like that. I can share it with you.
I think that group is owned by Fidelity, actually.
Oh, really?
Yeah.
But yeah, we just found a qualified intermediary and all they do is 1031 exchanges and you know they walked us through it.
Very cool.
Yeah.
All right, we've only got 4 minutes left in the meeting. I hate taxes.com. Thank you, Glenn.
Me too.
Does anybody have any last minute questions?
Hey, Jimmy, I've got a quick question on taxes. So I've been investing in Texas for a number of years, and I don't remember filing a Texas tax return. My CPA doesn't. Do we have to file a Texas tax return or no? Like a state tax return?
No, there's no, well, as a passive investor?
Yeah, as a passive investor.
Yeah, so if you're a passive investor, the property will file a Texas tax return and then you'll get the K1. So the K1 would just go into your local taxes. Does that make sense?
It does. I mean, I filed taxes in like a dozen different states. I don't remember Texas being one of those listed. Anyway, I was just wondering if you knew, because for me, that's one of the advantages of investing in Texas is there's no taxes, right? So the returns end up being quite a bit higher than investing in, say, California, which is 13%, Oregon, which is 10%.
Oh yeah, there's no state income tax. Correct. Yeah, so it's a maybe I'm confusing myself.
Yeah. As a passive investor, there's no income taxes in Texas.
Yeah, you're right. So the property would be filed as a federal tax return.
Yeah, you don't get a K1 for a passive investment in Texas.
Okay, thanks, Brian.
Yep.
That's my comment about the property tax trade-off. Yep.
Just a quick general question, Jimmy. If we're in Texas and we want to reach out, is there an email we might be able to contact you with?
Oh yeah. Please share your contact information.
Yeah, absolutely. My email is jimmy@high5multifamily.com. And our website is the same. It's HIGHFIVE multifamily.com. You can go to our website, see about me and my partner and the deals we've done. And there's a contact us form there, or you can email me directly, jimmy@high5multifamily.com.
Okay, Jimmy@high5multifamily. Thank you.
Yeah.
All right. Hey, everybody, can you take yourselves off mute and thank Jimmy for coming in and talking to us today?
Thank you,
Thanks, Jimmy. Appreciate it.
Thank you, Jimmy.
Thank you, Jimmy. That was great.
Thanks, Jimmy.
Thank you.
Thanks,
Really
man.
helpful.
Man, that was awesome. Thank you guys. I'm happy to be here.
Thank you.
And we will be back again next week on Friday. Oh, actually, I had a quick thing. I have posted quite a number of our previous videos out on the Rumble link, which I put into the chat. So check it out there. Subscribe to it if you'd like. I need a few more subscribers to actually be able to live broadcast on Rumble, so I would appreciate that. And we'll see you all again next week at noon Pacific. Cheers.
Bye.
Awesome. Thanks, Daniel. Thanks, Jimmy.
Thanks, everyone.
And don't forget, we're going to be taking a picture next week.
Oh, Daniel,
Yeah.
one question. From last week's meeting, you mentioned that coaching. I don't know if I got the link for the program. I don't know.
Oh yeah, absolutely. I should have mentioned it again. My partner will be sad that I didn't. All right, I'm dropping it into the chat right now.
Please, yeah,
not
thank
share
you.
screen. Chat. So it's right here. And this is a coaching program for people that are looking to find out what their preferred real estate strategy is. So we're going to cover a group of strategies, and then we're going to work with you in order to build a customized real estate plan that follows the strategy that you think that best fits you. Again, it's an 8-week program, and we're just looking for people to get off the ground or go in deep and build their portfolio.
Awesome. And there's a promotional period going on right now, right? Till
we were supposed to change it on Tuesday, but apparently there is a promotional period still going on. So
Okay.
yes.
All right, sounds good. Thank you.
Cheers.
Thank you very much.
Have a great weekend.
You too. Bye. Thanks, all.